Good morning, friends. Welcome to the Trade Speakeasy. So I just wanted to do a really quick video on how to sell covered calls and short puts against shares that you are already holding. I know a number of people in the EYL community are currently holding things like Square, Roku, Apple, Microsoft, and others. And so in this period of high inflation, the market has just been really heavy, and in most of the tech sector has basically now entered a bear market, except for a few underlyings like Apple and Microsoft that have been able to kind of stave off the 20% loss. But the QQQ has already entered bear market territory, and so that is starting to put a lot of pressure on Apple and Microsoft, which had kind of avoided that heavy drop that other underlyings have had, especially in the fintech and biotech sectors. And as long as we're looking at high inflation, we have to be realistic that a lot of those of us who are holding a high number of shares in these kind of blue chip firms may be now, facing what is an unrealized loss as the prices start to drop. And so the question is, what can we do in order to bring in some income against the positions that we are holding? And so I will actually look at today at Apple, which is now on the screen. And one of the main things that what I think is really important is the question that at any point in time, if you were to go to the broker and you would say to him, okay, I'm willing to make an agreement with you that if Apple were to drop to a certain level, that I would want to buy shares. So let's say, for instance, you're sitting here and you're like, if Apple were to drop below 140, I just think that is a stellar deal, and I would buy 100 shares. Or you say, I'm holding shares, and actually, let's say that we get some kind of parabolic move like this here, and you're like, okay, if we really were to get back up to, let's say, this 170 point, I'd be willing to sell my shares, because so what happens is that when you have these kind of parabolic moves, what happens? The most natural thing for the underlying to do is to have a pullback. So even if you were to sell your shares at the top of a parabolic move, you would have the opportunity maybe a week or two later to be able to collect those same shares, but at a lower price, right? So a savvy investor might say, you know what, if there's another parabolic move and we see Apple, let's say, hit right here where it did last time, then I don't mind selling my shares. Or if, on the flip side, if the price is to drop, and, because I have a long-term thesis on Apple, if price were to get to 140, I want to get those 100 shares. So basically what you do then is that you are selling the contract to the broker, saying that if price drops to 140, I want to buy 100 shares, but if price skyrockets to 170, I'm willing to sell my shares. So that's a commitment that you're making, right? And that is where you are selling a covered call, or you are selling a shares secured put. So, and basically what that is saying is that you can actually afford to buy 100 shares because you are actually holding 100 shares. So then basically the broker says, okay, you're basically guaranteeing that you will pay that difference. If, let's say, the price actually dropped to 138 and you have to buy 100 shares, but you can't afford to buy another 100 shares, you could sell your actual shares at 130 and then just pay that $2 difference per share. But how often that happens is very, very rarely, unless you're playing very aggressively and you're selling way too close to the current price. But so I'm going to show you how you can do the math on this so that you are selling a covered call, or you are selling puts, or you are doing both based on your thesis. So if you have a kind of more sideways feel about an underlying, so kind of what Apple is doing, where it is making lower highs and lower lows, but it's doing it in a very gradual manner. So it's not just like dropping the way square is, like where it's just been a total downward angle. But then you have other things like square where it's just dropping so fast. So in that scenario, like if you were looking at square, let's say you're looking at square here, and you just see that this is making, well, now actually square has seemed to find a kind of a price corridor. Like it is really spinning around this volume point of control. So we could actually say that square has now maybe found a quasi bottom and now is trading within a kind of a range and is trading around this volume point of control. So you might be willing to actually sell covered calls and short puts. That would be up to you. But let's say that during this period when all square was doing was dropping and dropping aggressively, you might just only want to sell above, because when you're a seller, you want the price to do whatever, like have the opposite move of whatever you're selling. So normally the idea is you want to sell a covered call because you think price is dropping, or you want to sell a short put because you think price is actually bullish, or you sell either one because you think that price is just going to stay between a really hard support and resistance area. It's just kind of moving within a corridor and isn't actually making new highs or making new lows. It's kind of respecting the floor and the ceiling of a price channel. So that would be up to you. So let's just go back to Apple, because that is moving more within a predictive channel. And so right now I'm looking at multiple time frames. We don't necessarily need to look at so many time frames like I have on here. So I'm going to shrink these and we'll just look at the daily chart. And one of the things, so I have the volume profile up, and I don't actually need that for this example, but what I will put on is just one moment. I cannot see. Yes. All right. So the thing that we do want is, and I'll explain why, is so I don't need the volume profile on here. What is more helpful, what is more helpful would be the cone of probabilities. And the cone of probabilities, or sorry, the probability of expiring cone. Let's apply. And so basically what this is helping you visualize is, as you look forward into the expiration cycles, so you're looking at, whatever the dates may be, this is where the math, basically the Black-Scholes equation, is giving you the trajectory that price is going to be within this area. And so obviously the cone expands into time. And what you want to do is you want to sell, basically, you will look at a date down here, and then you will be selling behind the cone of probability. So you are trying to get away from where you think price is actually going to move, but still take some income in. So you just have that on there just to give you kind of a perspective of where price may be moving. Even, well, whether it's bullish or whether it's bearish, the cone of probability is giving you that well-rounded kind of vision or visual of where price might go. Then you are going to head to the trade tab. And so when you are selling anything, you either are selling time or you are selling risk. So some people who own shares and they don't mind, moving in and out of shares, they will sell covered calls and short puts really close to the current price, because actually what they're trying to do is just bring in the most aggressive amount of money that they can bring in. And whether they get breached or not, they don't really care. They'll get rid of their shares because their expectation is that at any point in time, they can collect the shares again at a lower price and then start selling against those shares. So, but for most of y'all in EYL, that is not your thesis. You have a buy and hold thesis. You just want to be bringing in some extra income on a bi-monthly or monthly basis, right? So you want to look out about a month in time. And so you are selling time, and therefore you don't also have to sell a lot of risk. And one of the things you have to remember about theta is that theta decays on a daily basis. So this is why the days until expiration are including every single day of the week, including Saturday and Sunday, even though the market is technically not open for options trading. You will go to your trade tab and you will, check out whichever expiration you're looking at. And one of the things that you will notice is on the right side of your screen that there is this kind of percentage and then this plus or minus. And basically that is the implied volatility. So based on the historical math and the historical movement of the underlying, this is how much volatility the broker expects to be in this underlying. And the plus or minus is what the broker also expects the underlying to move between right now and your days until expiration. So as I said, we're going to look at this 31 days until expiration. So that's 1 month out. And it is telling us that Apple is likely to move $15 plus or minus. Right now we're at 151. So that would be, this is like the, that would be the central point. And then $15 above or below us would be 135. And $15 above us would be at okay, you can't see any of that now. So because of the way that I did it. So basically 135 would be our floor and our ceiling would be at 165. And so that is the $15 plus or $15 minus move of the underlying, because right now we're trading at 151. Now, an underlying can move what we would consider all the way to zero or all the way to the moon, right? So basically what the broker does is it gives you the percentage chance that the underlying is going to get to a certain destination or to a certain value. And that is your deltas. And usually people, if you're selling really aggressively, you might sell at the 25 delta. So you're selling at a 25% chance of being breached, of price reaching you. But if you're really not aiming to get rid of your shares, then sell somewhere between the 10 and the 16 delta. And so this is delta right here. So we're looking at this area right here. So that would be around the 130 or the 135 delta. And then over on the call side, we would want to look again for that 10. Well, we have a 9 and a 15. We don't exactly have a 16. And that is actually at the 170, 175. Now, the reason that this is not exactly caught up is because we are still in the pre-market and the option chain isn't open until the market actually opens. So these numbers will change a little bit once the market is actually open for the day. But so if you are selling, let's say that you are like, okay, I think that you go to your chart and you're like, okay, I think that we're getting to a really good support level. So I prefer not to sell a covered call because I think that we're going to bounce up. I just want to sell a short put because I think we're going to, price will come down to maybe 149 and then it's going to start heading back up to the top of this trend channel that we have going on here. So I can just, so here we have a bit of a trend channel here and a bit of another trend channel here. And then we have this kind of supply or demand area here. And so you're like, I think that we're going to come down to this demand area. We're going to pick up a bunch of buyers, and then we are going to continue back up. And I don't want to give up my shares so I don't want to get breached, right? So you come back to your trade tab and you can just sell a protective put. So you will right click, sell, single, and it will automatically show you 10. And you don't want to sell 10. You just want to sell. So every contract is relevant to 100 shares. So if you have, let's say, 241 shares, you can sell 2 or 3 contracts, depending on what makes the most sense for you. And for every contract that you sell, you will make $118. So, or $120. You can try to get the $120. So every contract is representative of 100 shares. So this dollar amount is showing you what you are basically being paid for every share that you hold relevant to the number of contracts. So if you sell 1 contract, you'll get $120. If you sell 2, you'll get $240. If you sell 3, you'll get $360, so on and so forth. Now, let's say, for instance, you have a totally opposite thesis. And because of the way that the market is moving, you go to your chart and you're like, no, Suzanne, this is not what I think. Okay, so here we have kind of a trend channel. Whoops, I made that a bit too steep. Yeah. And you're like, yeah, but then look at this. I think that we're actually wedging. This is not a proper wedge. But let's just say that was what your technical analysis was. This is not a correct chart pattern. Just have to put that out there. But let's just say that's how you did your chart. And so you are like, oh, we're already below the wedge. And I think that we are going to drop, and we are going to keep dropping until we get to the 140 support level. That was your thesis. That's how you charted out Apple. So then you're like, all I want to do is sell covered calls, because I believe that price is just going to keep dropping down to this hard support level since the entire market is dropping. That's my expectation. So I'm like, okay, then if these are your shares, you come up with a thesis of what you want to do. And so because you think price is dropping, you only want to sell a covered call. So you would come and you would sell this 15 delta, and here's the 15. And basically the 15 delta is a 15% chance that price will get there before expiration, and you right click, sell, single, because you're only selling the call. So it's a single leg, and you will be paid $115 for every contract that you sell. So if you sell 1, you'll get paid $115. If you sell 2, you'll get paid $230. If you sell 3, you'll get paid $345. Now, there's some people who are like, listen, I've been holding on to these shares forever, and I'm not really making that much money, right? And I'm bored just like sitting with these shares, doing nothing. Like one day I'm up $10, next day I'm down $5, and blah, 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 blah. And now I'm like, you go back to the chart and you're like, look, Suzanne, right now we're at 150. We were literally at 150 last September. So I've been sitting in all of these shares from September, October, November, December, January, February, March, 7 months. And my stock has done nothing. And so, yeah, let me get some money, because I've made $0 in 7 months. These are terrible employees. This stock has done nothing for me. I want to get my money back. So you want to be aggressive, but you don't really want to like lose your shares. You don't want to get rid of them, but you want to be aggressive in the fact that you want to sell above and below. So then you are going to do what is called a strangle. So you go back to your trade tab. Now you will sell to open a strangle, but you have to come back here and you have to select the right strike. So we already said that you will sell the call at 170 and you will sell your put at 135. Why is this not? Not letting me change. Okay. Let's try that again. So we will sell to open a strangle. and we will set the call at 170, and we will sell the put at, I don't know why this is not, I'm just going to do this and see if that works. Oh, it's really not letting, so normally this would let you change it so that you can select. Okay, I don't know why it is not letting me sell the Strangle. So you can actually just sell them, sell a single call and sell a single put. But now I will try it again. Let me see. No, it's just not letting me even select the put side. Okay, so I'll do it from here. I'll sell a Strangle so that it opens up on the put side at the 130. And now I will just adjust the top side to the 170. So now I am getting paid for selling the put at 130 and selling the call at 170. For every contract that I have, I'm getting paid $230. So yeah, and so that's both at the 11 delta and at the 15% delta, at the 15 delta. So on the bottom, the broker is saying I have an 11% chance of the price possibly getting down to me, and a 15% chance possibly of the price getting up to me. And here's the thing, right? Price cannot go down and up at expiration. Like the price can only expire in one spot. So no matter what happens, you will be making money from one side of this deal, because price cannot at expiration be $170 and be $130. The price can only be in one place. And as time, like theta, is decaying against this contract every single day, the window of how Apple can move starts to get more and more narrow. So this is why we look, you also want to look at this thing called the cone of probability. So right now we are looking at selling a month out. And so this is essentially where it's where the cone of probability is expecting the price to land. And which is right where, we've sold at, we are thinking to sell at the 130 and at the 170. But what do you notice about this cone of probability? That as the price moves and days go by, the closer you are to the current date, basically, the more narrow that window gets, right? So as this price goes up and down, the cone narrows. So as you're watching this, and you have 31 days on that contract, so you let 7 days go by, and this window of this kind of cone of probabilities is going to start getting shorter, because you have fewer days and you actually now have information about what the price is doing. And you will see, is it reacting to a resistance level? Is it bouncing up off of this potential support area? Did it skip that support area and come down to this support area? But whatever happens, as long as price is moving within your window of the short call and the short put, you're basically just taking in cash. Now, here's the thing. When you sell something like a covered call or a short put, or both, you sell a Strangle, the broker doesn't actually give you all of the money. What they do is they put the money in kind of a holding account, and until you close that contract. So there are two things that you can do. You can buy to close the contract for less. So basically you are selling your contracts high and buying them back lower, so you don't actually stay all the way until expiration. That's what I advise people normally to do. Or you can let these expire if you don't believe that the price of the underlying is going to come up to you or down to you. Now we can dig deeper into that, like how to buy to close, why you should buy to close, so on and so forth. But for right now, I just want to give you guys kind of the setup of how do you actually sell a covered call, sell a short put, or sell a strangle. And I've basically done that today by running through this example with you and why it makes sense. Now, at the Trade Speakeasy, one of the things that I always advise people to do is when you are starting to collect shares of any underlying in your buy and hold account, start selling strangles right away. And people always ask me, like, why should I start selling against them? I'm not losing anything. Because when you are under pressure to make money, you will start to sell, you will start to feel like, oh, I'm selling all the way at the, like if you want to sell at the 8 delta, right? A single at the 8 delta will only give you $83. $83 is like half of a share of Apple right now. So then you're like, well, why am I doing this futile exercise? But if you do this, the whole life of the shares that you are holding, like let's say, for instance, you literally do this every single month for the next 40 years, every week, or this is like 30 days, every month you're getting paid $160 for that one contract. But if you actually had 100, 200, 300, 400 shares, you'd be getting paid obviously a lot more. So you might be getting paid $160 or $320, right? And so you can sell further away. So you don't have to be really close, but then every month you're bringing in $360. And you do that the entire life that you hold the shares. And then you're never under like this intense stress that you need to sell really close. What a lot of people, like when they contact me, they're like, oh my gosh, all my shares are down like $50 a piece. I have 100 shares, so I'm $5,000 down. Now I want to start selling against them, selling against my shares. Well, now you're under the psychological pressure of trying to make back the $5,000 that this unrealized loss that you have in your account. And then you will start to try and sell more aggressively. So you will start to sell at the 20 delta. And let's say that 1 month goes by and you don't get breached and you're like, oh man, like, look what I did. I'm so savvy. And then the next month you'll start selling at the 25 and then suddenly at the 30. And then slowly you get more and more aggressive in order to take in more credit. And then you start getting breaches. Then you're starting to have to manage these strangles. And then you're in, but you like take a stressful situation, you make it more stressful. So what I always tell people is, as you're holding these shares, constantly sell while you're not feeling any stress about having to make money against them. So you get the feel of what this looks like month in and month out. You know how to buy to close. You know what it is you're aiming for, like how far away you want your strikes to be, how close you want your strikes to be. And you start developing your thesis, but in a non-threatening environment. So I hope this helps. But if you guys have any questions, just comment in the chat and I will, I can create more videos. I can answer you guys in the Telegram group. But I would greatly appreciate it if you would like and subscribe in the video if you want to see more stuff like this, because I'm happy to put these kind of short explanatory videos together, especially as the market is, constantly changing. You might have new questions or different questions than you had previously, but I do hope that this helps. And I'm really thankful to Tiffany from EYL for asking so that I could create this video for you guys. All right, have a wonderful day, friends. Bye for now.